look at the latest market feed today, and you really have to ask yourself, right, when a stock is flashing like heavy sell signals, riding this brutal falling trend, and screaming financial distress, but then it suddenly spikes 30% in a single day, is it a strong buy, some hidden undervalued gem, or just a massive, carefully laid trap?
Well, I mean, the immediate price action on a day like that is practically screaming opportunity to anyone who's just, watching the ticker. But beneath that 30% spike, the structural data is telling a completely different, much darker story about what happens when the music finally stops.
Yeah. And that tension between the flashing green of a daily chart and the honestly bleeding red of a balance sheet is what we're unpacking today. Welcome to the Deep Dive.
Glad to be here.
Today is April 22, 2026. And we are dissecting the absolute wild ride of Nuburu Inc. The ticker symbol is BURU. We're going to look at the real-time quotes, the underlying financials, and this intense technical tug of war happening on the charts right now to figure out if retail traders are spotting a genuine turnaround or if they were just, walking blindfolded into a buzzsaw.
Which means we really need to set the ground rules for how we look at this data. We are exploring conflicting signals, analyzing institutional metrics, and, well, looking at market psychology. This is absolutely not financial advice. We're simply examining the mechanics of what the numbers are actually doing beneath the surface.
Exactly, yeah. And before we rip into those charts, just a quick housekeeping note. If you're joining us for this deep dive on YouTube, take a second right now to like the video, subscribe to our channel, and you absolutely must leave your feedback in the comments. We read them all, and we want to know what you think of this stock. Are you buying the hype or staying far, far away?
Yeah, let us know because, the only way to understand why a 30% single-day jump is so polarizing is to first establish the baseline reality of Nuburu's historical performance.
Yeah.
The context here is severe value destruction. Over the past year, the 52-week high for the stock was $4.24. But recently, it cratered to a 52-week low of just 15 cents. As of yesterday's close, April 21st, it was sitting at 26 cents.
A drop from over $4 down to a quarter. For a lot of retail traders, that chart just looks like a massive discount. They see that historical high and think, oh, it has to go back up, right?
Oh, yeah. And that is a classic psychological trap known as anchoring bias. Investors anchor their expectations to that $4 price tag, basically tricking their brains into seeing 26 cents as a bargain rather than, well, a reflection of near bankruptcy.
Wow.
Because if you look at their 2025 Form 10K income statement, the reason for that price collapse is entirely structural. Their annual revenue came in at about $1.2 million.
Which represents a 92.7% year-over-year decline. I just need to pause on that because it's hard to even comprehend.
It's massive.
Right. How does a company lose over 9/10 of its revenue stream in a single year without just closing its doors completely?
Right.
What is the mechanism behind a collapse that catastrophic?
Well, a 90% revenue drop usually means the core business model has just hit a wall. In the tech and manufacturing space, this happens when legacy contracts dry up, or maybe a flagship product fails to find market fit, or the company halts production to pivot their entire strategy because the original plan was just bleeding too much capital.
I got it.
In Nuburu's case, their most recent quarter showed a net loss of roughly $5.1 million. So they are burning cash just to keep the lights on while barely bringing any money through the door.
Wait, hold on. This is where the math in the filings feels, entirely broken to me. The updated balance sheet data as of April 1st shows they actually have $24.7 million in cash reserves.
Right.
On the surface, $24 million sounds like a decent runway, but then the data highlights a current ratio of 0.04. If they have $24 million in cash, how can their liquidity ratio be that dangerously low? Are those funds restricted, or is something else draining the accounts?
Yeah, so the current ratio is what exposes the reality of that cash position. The ratio measures short-term assets against short-term liabilities, meaning the debt's coming due within the next 12 months.
Cool.
A 1.0 means you have exactly enough to pay what you owe. A 0.04 means you have 4 usable cents for every dollar of immediate debt.
Oh, man.
The $24.7 million in cash might be technically sitting on the balance sheet, but the mountain of immediate payables, debt obligations, and operational costs dwarfing it is immense.
Okay, let's unpack this, because having $24.7 million in the bank, but a 0.04 current ratio is, it's like having a vault full of cash, but the bank is foreclosing on your house tomorrow, and you've completely lost the combination to the safe.
That is exactly it. The cash is essentially already spent.
So they're walking a tightrope over a very, very steep drop. Which brings us to the Altman Z-score.
Mm-hmm.
I saw this metric in the research, and it's sitting at negative 122.31. I mean, I know anything below 1.8 is considered the distress zone, indicating a high risk of bankruptcy within 2 years, but negative 122.
Yeah, if we connect this to the bigger picture, the Altman Z-score is essentially a corporate stress test. It blends profitability, leverage, liquidity, and solvency to give us a single health indicator.
Right.
When you see a score plunge into the negative triple digits, you aren't just looking at distress. You are looking at systemic failure. It means the company is completely reliant on external financing, diluting shares, or taking on toxic debt just to survive the next quarter.
Wow.
That score is the ultimate baseline for why analysts are universally bearish on the long-term fundamentals.
Okay, but if the fundamentals are that toxic, the 30% spike we saw yesterday makes zero logical sense. Unless, of course, the price action is being driven by something completely divorced from the company's actual value. What are the day traders and the algorithms seeing that the balance sheet isn't showing us?
They are seeing a massive technical anomaly. The overall trend for the stock has been undeniably neutral to bearish for months, but yesterday the trading volume just exploded. 132 million shares changed hands in a single session.
132 million.
Yeah. To put that in perspective, the 65-day average volume for the stock is about 19.5 million.
That's almost 7 times the normal volume. I mean, that is not just a few retail traders sharing a tip on a message board. Someone or, some massive algorithmic system is aggressively moving money in and out of the stock.
Exactly. And when volume spikes like that on a penny stock, it immediately creates a technical battleground. Day traders start looking at momentum indicators. For example, the 14-day RSI, or Relative Strength Index, is currently hovering around 39.15.
In context, an RSI of 39 tells us the sellers are largely exhausted, right? It's like a rubber band that has been stretched as far down as it can comfortably go. It's primed to snap back up before it hits the overbought ceiling.
Yeah. That's the momentum argument. You also have the MACD, the moving average convergence divergence, sitting at negative 0.02. It's technically a bearish signal, showing the recent trend has been downward.
Okay.
But the sheer force of yesterday's volume and that 30% price jump is actively trying to force a bullish crossover. It's short-term momentum trying to fight the gravity of the long-term trend.
And you can see that fight playing out with the moving averages. The price just crossed above the 5-day simple moving average, which was sitting at around 20 cents. For a day trader, breaking above the 5-day line is like the starter pistol.
Oh, absolutely.
But the stock remains miles below the 200-day simple moving average. Here's where it gets really interesting. The stock crossing the 5-day average, but stuck under the 200-day, is like a submarine finally breaching the surface of the water, but realizing there's still a massive ice sheet blocking out the sun. How much momentum does this actually have?
Well, the dynamic between those two averages is the core of this entire technical tug of war. The 200-day moving average isn't just an imaginary line on a chart. It operates as an algorithmic tripwire for institutional trading bots.
Right. So imagine a massive dam holding back a reservoir of institutional sell orders. The day traders are throwing buckets of water at it, trying to push the water level up above the 5-day average. They get a little momentum going.
Yeah.
But the moment the price even gets close to that 200-day line or hits major resistance at 29 or 33 cents, the dam opens. The algorithms automatically trigger sell orders because the broader trend is still downward, and that selling pressure immediately floods the market, crushing the retail momentum.
Which perfectly explains the ceilings we're seeing. The stock finds strong psychological support around 19 cents. Buyers step in when it drops below a fifth of a dollar.
Right.
But it faces a brutal wall of intermediate resistance at 29 cents and major resistance at 33 cents. Breaking through those algorithmic sell walls requires a massive catalyst.
So the charts show us the battle lines and the sheer volume of the fight. But to understand the why 132 million shares were suddenly weaponized in this tug of war, we have to look at the news cycle. There are two completely clashing narratives right now. Let's start with the bull case. Why are people suddenly buying a company with a negative 122 Z-score?
Well, the fundamental catalyst is Nuburu's announced pivot toward the defense sector. When your commercial revenue drops 92%, you need a lifeline. And government defense contracts provide incredibly sticky, reliable revenue.
Sure. And the sources show they recently secured a $250,000 counter-drone order in the Asia-Pacific region. They also took a 70% stake in an Italian firm called Tekne, and their Maddox joint venture for defense manufacturing just officially entered the production phase. I mean, those are tangible operational milestones.
They are, and they provide a fantastic narrative, but the defense contracts alone don't explain 132 million shares of volume.
Right, that's fair.
For that, you have to look at the secondary, much more volatile bull catalyst, which is the short interest. As of April 7th, the short interest on Nuburu was an astronomical 35.42%.
Over a third of the tradable shares are sold short. Institutions are betting heavily that this company is going straight to zero. But how does that actually drive the price up?
What's fascinating here is that it creates the perfect conditions for a short squeeze. When an investor shorts a stock, they are borrowing shares they don't own, selling them at the current price, and hoping to buy them back later when the price drops to pocket the difference. But if the stock price starts rising rapidly, say, because of a surprise defense contract, those short sellers start bleeding money.
Because their potential losses are technically infinite if the stock keeps going up.
Exactly. And when the price hits a certain threshold, their brokers issue margin calls, forcing them to buy back the shares at market price to close their positions. This forced buying creates a massive wave of demand, which drives the price up even higher, forcing more short sellers to cover.
Wow, so it feeds on itself.
Yeah, it becomes an explosive, self-sustaining feedback loop. The day traders see the high short interest, they see the defense news, and they start buying aggressively to intentionally trigger that panic among the short sellers.
Okay, that explains the massive buying pressure. But here's the massive shadow hanging over all of this. The bear case isn't just about the terrible financials. It's about a structural event that just happened. A lockup agreement for 505 million shares officially expired just a few days ago on April 19th, 2026.
And this is the critical mechanism that turns a volatile trade into a potential trap. When a company undergoes restructuring or raises capital, early investors and insiders are often legally barred from selling their shares for a specific window, the lockup period. For Nuburu, that window just closed.
So what does this all mean? We have a defense pivot that sounds great on paper, but 505 million shares just got unlocked. You have insiders who have watched the value of their holdings plummet from $4 down to pennies. For months, they were legally trapped in a burning building. Now the doors are unlocked. Are retail buyers just serving as exit liquidity for insiders who are bailing out?
The timing is what makes this so dangerous. You have a short squeeze setup happening at the exact same moment as a massive insider unlock.
Right.
The 132 million volume we just saw wasn't organic interest in counter-drone technology. It was a chaotic, violent collision. You had short sellers panic buying to cover their positions, colliding head-on with desperate insiders dumping their newly unlocked shares into that exact buying pressure.
So the day traders are trying to squeeze the shorts, but they are actually just providing a convenient off-ramp for insiders to cash out before the stock drops any further. When you combine that with the company's continuous cash burn and the fact that they've been constantly diluting the share count to stay afloat, I mean, the whole setup feels engineered to crush the latecomer.
It really does. Which brings us to the ultimate question of value versus trap. If we look at the broader consensus, major AI analysis tools and institutional rating models are practically unanimous. They are flagging Nuburu as a strong sell to sell.
Yeah.
The smart money is not buying the defense pivot narrative as a long-term cure for their balance sheet.
And the valuation models are brutally stark. Look at the alpha spread analysis. Based on their current cash flow projections and fundamental health, they estimate the intrinsic value of Nuburu is $0.0008.
Less than 1/10 of a single penny.
Less than 1/10. Wait, let that sink in. The mathematical intrinsic value of the company is less than 1/10 of a cent. Yet the stock is trading at 26 cents, and people are calling it undervalued because it used to trade at $4. Isn't buying at 26 cents essentially paying $1 for a winning lottery ticket that has already expired? The numbers printed on the ticket look great, but the entity backing it cannot legally pay out.
That analogy cuts right to the heart of how retail traders misunderstand the market. There is a massive difference between trading volatility and investing in fundamentals.
Right.
The trading algorithms and the momentum day traders who are buying at 26 cents do not care about the .0008 intrinsic value. They do not care if Nuburu exists in 2030. They only care if the short squeeze mechanics and the RSI momentum can push the price to 30 cents by Friday afternoon. They are surfing the chaos.
Yeah, the danger is for the casual retail investor who reads a headline about a defense contract, looks at the 52-week high, and buys the stock thinking they're getting in on the ground floor of a major turnaround.
That is the textbook definition of a value trap. The stock has fallen so far that it visually looks cheap. The retail investor suffers from FOMO, the fear of missing out on a 1,000% recovery run.
Totally.
But they ignore the fundamental decay of the asset. When you buy into a penny stock under these conditions, you aren't just fighting volatility, you are fighting the very real risk of delisting. If the major exchanges delist the stock because it fails to maintain minimum price requirements, your liquidity vanishes.
Poof. Gone.
Exactly. What looks like a turnaround is often just a dead cat bounce, a temporary sharp recovery in a long-term downtrend driven entirely by short covering. Once the shorts finish covering, the buying pressure evaporates and the stock resumes its march toward zero, leaving the retail investor holding a worthless bag.
Wow. So we need to project what the actual timeline looks like for this stock. Let's lay out the best case short-term outlook versus the worst case long-term reality.
Well, in the immediate short term, the next few days and weeks, the forecast guarantees extreme volatility. The market is still trying to absorb and digest the impact of that 505 million share lockup expiry.
Right.
If the momentum traders can sustain the buying pressure and force more shorts to cover, short-term technical models suggest a potential recovery target pushing toward that 30 to 35 cent resistance zone by the end of April.
So there is a highly speculative, incredibly risky window for swing traders to make a profit if their timing is like absolute perfection. But what happens when we zoom out?
The long-term outlook is incredibly bleak. While some generous average forecasts for the end of 2026 sit around 38 cents, the projection for 2030 tanks to as low as 4 cents per share.
4 cents.
Yeah. Unless the company achieves a miraculous, unprecedented level of profitability through these new defense contracts to offset their cash burn and negative Z-score, the mathematical reality simply does not support their long-term survival.
So we are looking at a stock living in two completely conflicting realities at the exact same time. The historical financials, the suffocating current ratio, the insider unlocks, and the intrinsic value models are all screaming distress. They're telling you to run away. But the short-term volume, the defense pivot headlines, and the massive short interest are screaming opportunity to anyone willing to gamble on the momentum.
This raises an important question, right? If the fundamental math dictates that the underlying company is practically worthless, yet the market psychology is currently driving the exchange of hundreds of millions of shares at 26 cents. What happens to all those retail buyers when the music finally stops and there are no more short sellers left to squeeze?
That is the ultimate question you have to answer before you ever hit the buy button. Thank you for joining us on this deep dive into the chaotic, conflicting data behind Nuburu. As a reminder, if you are watching on YouTube, drop a comment below and let us know your take. Are you trying to surf this volatility, or are you staying safely on the shore? Keep questioning the numbers, and we will catch you on the next one.